Why do most investors underperform even when they know what to do? Because they do too much. For the last 6 years, I followed a simple strategy. Fewer high conviction bets held for the long term. The result? A 21% annual return, nearly 8 percentage points higher than the S&P 500. That means almost doubling my money every 3 years at the time of recording this video. In this video, I'll break down why a strategic laziness investing approach has worked for me and how you can benefit from it too. So let's dive in! Most people think good investing means always doing something, analyzing, trading, reacting to the news. But the reality, the more we do, the worse our results tend to be. Think about it. How often do we check our portfolios? How many times do we feel the urge to take profit or cut losses? The best investors don't act often, but when they do, it counts. Warren Buffett said it best. The stock market is a device for transferring money from the active to the patient. Mohnish Pabrai, one of the best investors in the world, took that advice literally. His strategy? Find great businesses for less than they are worth, make a few big bets, and then do nothing. Pabrai follows a low-risk, high-uncertainty approach. He looks for undervalued businesses with strong long-term growth. He invests heavily when the odds are massively in his favor. He holds for years, sometimes decades, until the market catches up. This is not about finding constant hunting for opportunities. It's about waiting for rare, high-conviction moments, then making them count. In an interview, Pabrai referenced a Seinfeld episode. A character sits on a plane, staring at the seat in front of him, doing absolutely nothing, and is perfectly content. Pabrai says, if you can be that person, you can be a great investor. Because investing rewards those who can sit still. But most people cannot. The real challenge? Patience. The hardest part of investing is not picking the right stocks. It's having the patience to let them work. Ask yourself, could you hold the stock for 10 years without checking its price every week? If the answer is not an easy yes, then maybe the biggest risk is not the market, it's your own impatience. Over time, I realized that investing is not about being the smartest person in the room. It's about staying out of my own way. Here's what is working for me. Fewer big bets. Instead of spreading too thin, I focus on great undervalued companies with long-term growth potential. The kind that don't need constant monitoring. A concentrated portfolio. I will never want to own 30 plus stocks. I wouldn't have time to truly understand them. Instead, I focus on a few great businesses I know inside out. The patience to do nothing. When I feel the urge to act, I remind myself, time is my biggest advantage. The less I interfere, the better my results. When market drops like they are right now, the instinct is to act. Sell, rebalance, try to time the bottom. But the investors who make the most money, they survive the downturns and put more money to work when fear is highest. Most investors fail not because they pick bad stocks, but because they cannot sit still. They feel the need to act, they try to outsmart the market. They chase quick wins. But the best investors, they make a few great decisions and then they wait. The real question is not, how do I find the next Amazon? The real question is, how do I make sure I'm still holding Amazon 10, 15, 20 years from now? Because in investing, doing nothing is often the smartest move you can make. There is a reason Buffett, Munger, and Pabrai all preach patience. Survival in investing is not about finding the right stock. It's about not getting shaken out of great investments too soon. So maybe the biggest hate in the market is not intelligence. Maybe it's just having the patience to let compounding do the work. This is it for today, guys. If you got value from this video, feel free to drop a like. And if you want to receive more contents like this, feel free to subscribe. Thank you all and peace out!